Okay. Hello again, everybody. Welcome to the webinar on affordable small dollar loans, an alternative to payday or car title loans. Again, my name is Kevin Kelly. I'm the Director for Community Economic Development here at the Partnership. I encourage more community action agencies to take on economic development and housing projects. And today, one of our webinars on different aspects of community economic development. Today, we're hearing from Matt Hall, who's the Executive Director of the Texas Association of Community Development Corporations in Austin, and from Sherry Early-Aiden, who's the Vice President of Operations at Brightpoint, the action agency in Fort Wayne, Indiana. Matt and I had met several years ago when I was at a previous job, and we connected at the Partnership's annual convention in Austin a couple of years ago. So we had some conversations, and he shared with me some details of the small dollar loan program, and we thought it would be a good fit for a webinar. And we were right, because we had 120 people signed up for this as of this morning. The Texas Association of CDCs is working to replicate this program across the country, and Brightpoint is one of their partners. Here are the co-founders of Brightpoint Development Fund, which we'll be hearing about. In 2010, Brightpoint began a community lending program, and has since become an SBA microloan intermediary and a CDFI. So, Matt, I'll turn it over to you.
Thank you so much, Kevin. I really do appreciate the opportunity to talk with everyone about the Community Loan Center of America. And, Sherry, you're with us as well?
Yes, thanks for having me.
Correct. And the Community Loan Center is an alternative to pay lending and auto title lending, which, as we'll see, is a real problem both nationwide, but particularly here in Texas. And it's designed as a turnkey product to allow local organizations to be able to combat payday lending and auto title lending directly by competing with pay lenders locally. So let's get into it. Many Americans live paycheck to paycheck. We know this, you know this. Most of the clients that you work with in the community action space are going to be low and moderate income individuals in the community. Many people are not able to save up to where when they have an emergency, or what we call when life happens, they're not able to take care of that through savings. Oftentimes they're not able to borrow money from their employer or from friends and family, and in many cases they resort to high-cost payday loans. About 12 million people annually borrow from payday lenders. In Texas, that number's around 4 million people. And in Texas, what we've discovered is that over 50% of all of the profits derived from payday lending nationally come from Texans. So we have a particular interest in trying to combat this. Right now, across the country, it's about a $27 billion annual loan volume, which puts the interest and fees over $10 billion. So what does it look like in Texas? Even in what we would consider a mid-sized town, Waco, Texas, which has about 200,000 people, there are 33 payday and auto title lenders in the town. They take about $21 million in fees annually, and 472 cars were repossessed in 2016. Compare that to the state of Texas, where it's right at a $6 billion a year industry, where there's over 3,100 payday and auto title lenders, where they take just over $1.6 billion out of the local economy, and where in Texas we repossessed 37,000 cars in 2016. What does it look like in our largest marketplace in Houston? In 2016, it's 50 auto and payday lenders, $244 million in fees charged, and just over 6,000 cars repossessed. Texas has probably some of the most lenient payday lending laws. It really is the Wild West when it comes to high-cost lending. Our typical APR on a payday loan is just over 660% APR. Not only does payday lending affect the borrower, it also impacts the workplace. 8% of HR professionals have said that financial stress is one of the leading causes of distraction or presenteeism in the workplace. The leading cause is divorce. Second leading cause is financial stress or worry. Sorry, with the slides for a second. There we go. And about 24% of people surveyed have admitted that financial stress causes distraction in the workplace. Anything that you've learned about what's going on in Indiana that can help shed light on this as well?
I can share that our average payday loan percentage is around 390%. And we recently were, I don't even lucky, we were blessed to stop legislation here in Indiana that would allow payday lenders to lend more and actually charge more interest, which would have been, our opinion, devastating to clientele that we serve and that are currently using payday loans. So it's only, or I should say payday lenders are only become more aggressive to take over more of the market share when it comes to the dollars underserved individuals have.
Great, thank you. So not only are payday lenders prevalent in low-income communities, certainly in Texas, but I imagine in your neighborhoods as well, not only are the borrowers suffering, but employers are suffering, but employees want more financial security. The research bears this out. About 40% want to have access to greater financial security, and they would like their employer to help with that. So given what we talked about, all of the concerns in the marketplace, what is one of the solutions? And the solution that we have is the Community Loan Center. It's an alternative to high-cost payday lending. It's a market-based approach. It's fairly priced, and we'll get into what that means in just a minute. And it's an employer-based program, meaning that we work with employers and through employers to target employees of companies who sign on. So the only eligible borrowers to the CLC program right now. The program is designed to be sustainable and scalable. Sustainable in the sense that the interest and fees generated on the loan will help pay for the operation of the program and eventually, when your volume gets high enough, actually generate revenue toward the mission of the organization, but scalable as well. When we first created the program back in 2011, we realized that, and it started in Brownsville, Texas, we realized that if it can work in Brownsville, Texas, it could work in Houston, Texas, it could work in Dallas, Texas, and now we've learned is that it can work in Fort Wayne, Indiana, Lafayette, Indiana, Baltimore, Maryland, Raleigh, Durham, Chapel Hill, Triangle area. So we're able to replicate this, bring on local lenders to help provide the loan product locally to help combat payday lending as an issue. It's employer-based. That we're able to make the program work is that we encourage the repayment of the loans through payroll deduction. There's storefront, everything is done online, so it makes it very efficient. You don't have to have staff, manning a front desk or talking with clients directly. And there's no cost to the employer, so there's really not a financial barrier for employers signing up. Improved efficiencies, everything is done online as a software as a service. The loan origination and loan servicing is contracted back to the franchisor, which is the Rio Grande Valley Multibank. They own the software, and they provide the online origination and the loan servicing for a modest fee. It's nonprofit driven, so we're able to work with nonprofits and for-profit organizations. Nonprofits have the advantage in this program that foundations and corporations can provide grants to help provide for the loan pool. And banks that invest in it are able to get CRA credit as well. Terry, anything you would like to add at this point?
No.
So let's dig into terms just a little bit. Currently, a maximum $1,000 loan or up to half of the borrower's monthly gross pay. So if someone only earns $1,800 gross pay in a month, they could only borrow up to $900. The term is 1 year, and that is divided depending on the pay period of the borrower. So if they're paid monthly, it's 12 monthly payments. If they're paid twice a month, it's 24 payments. If they're paid weekly, it would be 52 payments. It's an 18% interest rate with a $20 origination fee, so that puts the APR on a $1,000 loan just over 21%. It has relaxed underwriting. We don't necessarily look at every borrower's credit worthiness. We don't pull credit reports. We look at the stability of the employers. And for the underwriting of the borrower, we look at, are they 18 years of age or older, have been employed at that company that is signed up as part of the program for more than 3 months? Do they have a valid photo ID, and that photo ID tied to a bank account where we can deposit their funds? There's no collateral requirements. There's no prepayment penalties. We have an online web portal to where borrowers can go in and make advance payments if they want to pay off the loan early. And all this basically means that if they're paid weekly on a $1,000 loan, their payment will be just over $23 a week, or if they're paid monthly, it'll be around $94 a month. How does the Community Loan Center compare to other loans available in Texas? So you'll see the bottom line, our average loan size is $941. Over the course of a year, it means that the borrower will pay us back in principal, interest, and fees right at $1,056. Compare that to a single payment deferred, that is what was typically a payday loan in Texas. They kept that loan of $941 and had to refinance it every 4 weeks, which is our typical term. They'd pay back $5,000 on that $1,000 loan, or $941 loan. So who are we? I work with Texas Community Capital in addition to working with the Texas Association of CDCs. We are technically what is known as the sub-franchisor, and I'll get into that in just a second. But this program is created by the Rio Grande Valley Multi-Bank, a multi-bank CDFI in Brownsville, Texas, and they work in the 4 of the poorest counties in the country along the Gulf of Mexico and bordering the Rio Grande River. They are associated with the Community Development Corporation of Brownsville, one of the largest affordable housing providers doing both multifamily rental as well as single-family home ownership. They do about 100 new homes a year. They created the program, started lending in October of 2011, and they saw a proliferation of payday lenders in their downtown area to where they went from having 5 regional banks and only a handful of payday lenders to no regional banks and about 27 payday lenders within a 5-block radius of their office. So for them, they were seeing a number of their clients coming in for home ownership getting knocked out of that process because they were taking out payday loans to pay for car repairs, medical expenses, and it was a negative impact on their ability to build assets over time. The Texas Community Capital is a nonprofit loan fund created in 2004 by the Texas Association of CDCs. We're a state trade association representing nonprofits affordable housing across Texas. We created a loan fund to help serve their needs, and then brought in the Community Loan Center as one of our flagship programs. Gary, do you want to talk a little bit about Brightpoint and how the CLC fits into your program?
Brightpoint is a community agency that, of course, like all of you on the phone, I believe, built out of Lyndon B. Johnson's War on Poverty. We started a community and economic development division, our agency, in 2009. In 2010, we started doing employee loans ourselves in-house. During that time, we were ready to apply for SBA micro-lending status as well as CDI certification. And so to actually get our feet wet and get an understanding of not just the need, but also the process and procedures needed to be able to administer a loan program, we did small dollar loans up to $1,500 to our employees. Just a little bit different program. We were at a 10% interest rate, and we didn't have an origination fee. It was all payroll deducted, and you could have up to 18 months to off your loan. So as we had been doing this for quite some time, the opportunity to join the CLC in 2015 was a great way for us to expand the consumer loan product that we were just offering to our employees. At that time, we probably had an employee base of about 200 and 250 employees. We cover probably about 15 counties in Northeast Indiana. So now that we have the CLC with 8 employers, and we have access to over 10,000 employees. So it has allowed us to meet our mission of helping low-income individuals become sustainable, but at the same time, hopefully build credit so they can actually participate in what many of us already do by going to our local lenders and getting a reasonable rate and loan that we can use for our everyday needs.
Great. Thank you. So we've talked a little bit about who we are. Now let's talk a little bit about what we do. So the Community Loan Center program is set up as a franchise, and that's under Federal Trade Commission rules and regulations. What that means is that in certain states we have to file a franchise disclosure document, which is just about a 120-page document that explains the Community Loan Center program and who we are, provides our financial background, et cetera, and everyone gets that document. And it all means that, and one of the reasons that we're a franchise is that we charge an annual licensing fee for access to the software. That's one of the triggers that requires being a franchise. So just keep that in mind as we talk about franchisor and sub-franchisor and franchisee. So the owner of the program is the Rio Grande Valley Community Loan Center, which is part of the Rio Grande Valley Multi-Bank CFI. But technically, they're the franchisor. We have a contractual relationship with them to market the program across the country as Texas Community Capital, operating as the Community Loan Center of America. That makes us the sub-franchisor. And then we recruit local lenders around the country, and those are the franchisees who are contracted back through CLC of America. So the Rio Grande Valley Multi-Bank, they've developed the software and they maintain the software, and then they are contracted to originate and or fund the loans and to provide the back office servicing, so that you have to do that locally. The organization, we provide the sub-license that allows you access to the software. We also create intellectual property marketing materials that we share across the network so that you don't have to create those things yourself. And then we are also a licensed lender in Texas. So where we don't have a community loan center in Texas, we can be the local lender. The thing that we do is that we provide a 10-part training series and program manuals to provide all of the technical assistance and capacity building and training that local organizations need in order to get up and running. In states, we do have a statewide coordinator. These are typically state nonprofit trade association type groups like TACDC. They help us market the program to their members and to other organizations in their state, and we pay them a small referral fee. Your organization would be the local CLC lender or the franchisee. You have really same responsibilities. It is to recruit employers to participate in the program and then market to those employees, and then to raise the loan capital needed to originate those loans. There is a little bit of servicing whenever a loan goes into default, fairly rare, very fortunately. So the main two jobs, again, recruit employers and raise the loan capital. Sherry, have any comments on this slide as the local lender? Is there anything that I'm missing out that you think is a critical piece of information for new organizations to think about?
And that would be that you can elect as the local CLC to be the kind of intermediary between you and the third-party servicer out of Texas. And that has been something that we do because we know that our clients here in Fort Wayne or in Indiana want to talk to someone in Indiana. And so we someone that field those calls and those questions, and then they work with Texas to address any challenges or issues.
Great, thanks.
Hey, this is Kevin. There's a couple of questions that came in I think might be good to handle.
Yeah.
Pretty specific. Okay, $100 from each loan. You were looking at one of the earlier slides. And the second question is, do you have to be a CDFI to a CLC?
So the answer to the second question is no, you don't have to be a CDFI. We have all kinds of organizations. We do have a few CDFIs that are participating. We have regular CDCs that traditionally have been housing organizations that have started operating as the CLC of Greater Houston, for instance. We even have two community action agencies, Bright Point, which does have a CDFI, but it's a community action agency, but also the Community Action Agency of St. Louis County with Cindy Bosman there. I don't believe that they're a CDFI. The answer to the first question is, on a $1,000 loan with a one-year term, you will earn roughly $96 in interest, and then, or maybe it's $104 in interest over the term, and you get a portion of the $20 origination fee. So your total, and we'll get to this in a minute on another slide, is going to be around $100 to $115 per loan. All right. So,
I'm sorry.
Please, go ahead.
All right, this is the only thing that is required of any CLC is that you become licensed in which you're doing the consumer lending. So if you're not already a licensed consumer lender, that is one thing you would need to become before actually running the CLC.
Thank you. You're absolutely right. Most states do require that you become a licensed lender. In Texas, it's through the Office of Consumer Credit Commissioner. In other states, it's through the Department of Banking. And if states don't require licensing at all, but they seem to be in the minority. So it basically just shows the exact same responsibilities on the left side. On the side, just wanted to go through kind of the flow of money. So the local lenders go out, which is the orange box, would get to recruit grants and loan capital from investors or lenders. That money goes into a jointly held bank account. Right now that is through Frost Bank, which is a Texas-based bank out of San Antonio, Texas. You would have a bank account jointly held by yourself and Rio Grande Valley Multi-Bank, because they will be pulling money out of that account to fund loans. They will also be putting interest payments and principal payments that they collect back in that account for you. When a borrower, which is the purple box, applies for a loan, it typically takes about 48 hours to get funded. So they apply for a loan, that triggers in the software system an email or a notice back to the employer to verify employment. Once the employer verifies employment, it triggers a notice to go back to the borrower, who then logs into their account and electronically signs the loan documents. When we hit submit, that triggers a funding request to the Rio Grande Valley Multi-Bank to fund the loan. They pull them out of the local lender's bank account and deposit into the borrower's account. That then triggers a payroll deduction schedule. If that's what the borrower decides how they want to repay the loan is through payroll deduction, that sends the payroll deduction schedule to the employer, and they enter it into their payroll system. And then every pay period, make payments back into that funding account that's held by both the lender and the Rio Grande Valley Multi-Bank. And the local lender can pull any profits out, interest and fee payments back out of that, to either help sustain the administration of the program, or they can let it grow and stay in that account and grow their lending capital. So this is, in essence, the simplified version of how it works. So the structure, again, everything is online. The software system is called KENN, K-E-N-N. The application portal is open 24 hours a day. The employer has the portal in the system by which they can go in and verify employment or terminate employees if someone loses their job. the local lender has a portal to where they can go in and manage and monitor all of their lending activity. They can also do accounting in it, which we have a plugin that ties into QuickBooks right now. And then an administrative portal that the Rio Grande Valley Multibank uses to manage everyone's accounts. Everything automated as much as possible right now for efficiency. We're always making changes and improvements to the system. Sherry, on average, how much time do you think it takes organization to administer this program with your given current level of lending activity?
I would say that she might spend 10 to 15 hours a month, and currently have 650 something loans that done, and I think 450 of them are currently on the book still.
Okay, so 10 to 15 hours a week. Okay, sorry,
a month. Yeah.
Thank you so much. The benefits to the employers, again, the local list job is to go out and to recruit the employer. This is a no-cost employee benefit. There's a direct cost to the employer. There's a little bit of time on their end to set up payroll deduction and to verify employment or to terminate an employee if they lose their job. What we're finding just anecdotally talking to the HR staff and the payroll staff that we deal with is that it's an impact of reducing employer financial stress in the workplace. Seems to increase workplace morale. Many times borrowers or employees don't realize that they're not borrowing from the employer. So, for them, because they go through the employer to get the loan, because they marketed that way, they think that it's their employer providing them resources. Obviously, there's a loan agreement. It has the community loan center of, blank location as the lender, and it's classified. But sometimes up front, borrowers do think that the employer is responsible. If, as an employer, are doing payroll advances, that gets a little tricky towards the end of the year. There's tax liabilities because it's considered an advance on salary, and going through the CLC program eliminates all of that. It is a loan between the employee and a third-party lender. Free financial counseling available to all borrowers. It's not mandated. It's not a requirement of the loan in any means. But one of the requirements of a local lender joining the CLC program is that they have the ability to either provide financial counseling in some capacity directly to borrowers, or that they're contracted with a third party to do so. These are a few screenshots as to what the application looks like. It's very basic, collects all of their basic information that we can verify the loan with the employer. The back end of the administrative portal allows you to manage the program. Sherry, have you had any issues with the KIN system, or is there anything that I've left out that you would want others to know about?
I'd like to say that we've made recommendations for some changes in the KIN system, and all of them have been honored. I think it's great to be able to work directly with the individuals that are managing the platform, because it allows us to address any challenges as they come about. And I think the more we all use it as a group, we discover ways to make it more convenient not only for ourselves but the employers. So it's been, on my end, great to be able to have that much input and get changes made. So it's been good. Thank you.
No, yeah, and that's an important point to make. Right now we have 15 local lenders signed up across the country, working with another 5 or 10 to encourage them to join eventually. Your organization was probably one of the first 6 or 7 groups to join. You joined in 2015. It was still a fairly new product at that point. Even to this day, we still have a partner phone call once every 2 weeks to go over, like you needed changes to the software, issues that arise, share best practices, share successes, cry a little bit over failures. But you're right. This is very much a program that is driven at the local level. As one of the organizers, it's good to hear that we're being responsive. And it's not perfect. It will get better over time as we continue to tweak it and go into new states. So what have we been able to do so far? In the first year, from October of 2011 to October of 2012, with one lender in Brownsville, Texas, they originated 792 loans, given that they had no idea what they were doing. Since then, expanding into 15 markets, 12 of which are actively lending. We did our 33,000th loan to date, working in Texas and Indiana, and also Baltimore, Maryland is an active lender now. We've loaned out just over $25 million, or we've advanced $25 million to borrowers in those three states. We're active. We've recruited about 145 employers in those 15 markets. We've got just over 74,000 eligible borrowers. Our largest employer right now is the city of Dallas. They have 13,000 employees. We have recruited the city of Houston, and they have 23,000 employees, but the local lender hasn't actively started lending to them yet. They estimate they're going to need about $3 million in loan capital, and they're working to recruit that much. Our network right now, we are at about a 4.7% loan loss over the history of the program from October of 11 through the end of last month. The Rio Valley Multi-Bank had 2 really bad years where they were in double-digit default rates. They've since brought that down. Taking out of the equation, the overall loan loss rate for all of the lenders is right at 3%. So it's just some of the historical losses from the Rio Grande Valley that takes it up to 4.7. Over the last 15 months, our loan loss rate is 3.2%. So given we've made 33,000 loans, advanced over $25 million, we've saved borrowers who are estimating just over $17 million compared to what a payday loan in Texas would look like. So just a graph showing the originations over time. You can see where the other lenders come in and how those lenders have contributed to the, I guess right at this last year we had just done 30,000 loans. So just in months, we're now over the 33,000 loan total. Our goals and impacts short term, we want to create a successful kind of a turnkey program that local lenders can bring into their program and provide locally to be able to help combat payday and auto title lending directly in low-income communities across the country. Internally, our goal is to recruit 10 licensed CLC lenders over the next 24 months and have those lenders hopefully generate somewhere in the neighborhood of 10,000 new loans. Long term, it's to build a scalable and sustainable program, one that local lenders can implement, have in their community, but also allow them to either at least break even, but also generate revenue back to support the overall goal and missions of their organization. And, if we're not able to hit that 10,000, new borrower goal, and if we're not saving $775 a loan like we are in Texas, but it's a low amount, we still have great impact across the country. At times, potential lenders want to know, how do we evaluate the program, because they're already kind of anticipating going to banks, corporations, and foundations and trying to figure out what those outputs and outcomes would look like. And the software system generates a lot of information back to the lenders. At any given time, you can look up your total loans originated, your open loans, historic closed loans, total capital loaned out to borrowers, loans originated, rates of delinquency, and we measure delinquencies from 30 to 60 days, 60 to 90, 90 to 120, and then anything over 120 is considered a default. Number of CLCs operating, number of employers, number of eligible borrowers. And we're working with Texas A&M University as well as Texas Appleseed to do a little bit deeper dive on what our borrowers look like across the network, and we're happy to share all of that information when we get it. Sherry, have you seen your funders request different types of information related to the CLC program? And if so, how did you go about getting it?
And I will say we collect a lot of information already just because we're an SBA microlender and a TDFI, so it made it a little bit unfair. We're already collecting what banks want from us and our funders want from us just because we have to do it for the federal government. But there's nothing on the list that you've provided that haven't been asked for. We've been asked for the majority of those things there.
Great. Have you been asked for anything that the KIN system wasn't able to provide?
But the KIN system is working on it.
Okay.
And that is wants to be able to get a little deeper when it comes to demographics and knowing male, female, and age grades. And so we've been talking about how that might be able to be extracted from KIN.
Okay, great. So our nationwide expansion plans, obviously we have lists signed on in 6 states now, and we want to target those 6 states, but also expand into new states. So we are not shy about working with new organizations that approach us. We have a pipeline right now of probably 15 organizations in 12 different states. When we go into a new state, it does take us a little bit of time to work through the state regulatory issues, typically working with the local lenders, working with the regulatory bodies to make sure, like our loan documents meet their state statutes and regulatory requirements, making sure that our collection methods do as well, make sure that the fees that we charge and the interest that we charge all fit within their state regulatory environment. Once we're approved, once the first local lender is up and running, it's a very quick process to bring on the second, third, fourth, and fifth lenders in those states because we just allocate all of the same documents. So just keep that in mind as you have interest in the program and as we start working towards bringing it to your area. So what does it mean to bring the CLC program to your area? How do you go about getting involved? You reach out to me, and my contact information is on the last slide. We will send you an application packet. You complete that, and that's really showing that you're committed to being a local lender. The application packet is about what you would write for a typical grant, and it just provides us some assurance as to who you are and that you have the capacity to actually be in the program. You should have a goal to raise somewhere in the neighborhood of $250,000 to $500,000 in your first year or so. Because it's a maximum $1,000 loan, $250,000, you can make somewhere in the neighborhood of 320 loans a year with that because of the way that the money revolves. And we estimate that we're making somewhere in the neighborhood of loans to 15% of all eligible employees per employer. So if you have 1,000 employees on the company that you recruit, you're going to make probably somewhere in the neighborhood of 150 to 175 loans per year to those eligible borrowers. Sure, you've experienced something slightly different with one of your larger employers, but in general, does that kind of hold true for you?
It does, and I would say that's including the renewals. When you first hear that number, you're like, wow, that's a lot. But what often happens isn't necessarily that you're getting brand new borrowers. You are, but in addition to that, you're getting borrowers that are renewing a loan that they already had with you, so they've paid down their 50%. So that then counts as a new loan. So yes, I would agree.
So you bring up a good point. We do allow borrowers to renew their loan. If they have to, the criteria to renew is they have to pay off half of the loan first, and then they can take the proceeds from the new loan to pay off the remainder. So if they borrowed $1,000, once they get down to where they owe less than $500, we would allow them to renew. We would issue them a new loan and put the difference between what they owed and the new loan amount into their bank account. To the goal to raise loan capital, you will need to be able to provide for roughly a full-time equivalent or a part-time equivalent to help administer the program. We estimate for most lenders it's going to take probably 2 to 2.5 years to get to the point where they have enough lending volume to be self-sustaining. So they will need to subsidy for that FTE somewhere in the neighborhood of $40,000 to $60,000 over the course of the time period in which they're ramping up to be sustainable. You would want to be able to recruit employers, and some of our local lenders have recruited up to 5,000 employees or eligible borrowers within their first year. That's a little aggressive, and it really goes hand in hand with the amount of lending capital that you have. So depending on the lending capital at your disposal, then that would help dictate the amount of eligible borrowers you can bring into the program. So also you would want to have local partnerships to recruit employers. You may already have that, but you may want to work with your local United Ways or Chambers of Commerce or the local HR firms to be able to get the word out about the program. You need to be able to provide financial counseling or coaching when it's requested by the borrowers. Again, it's not mandatory, but it is mandatory as a lender that you be able to provide that at no cost. And then if you want, you can report to credit bureaus to at least one credit reporting agency to build the credit of the borrower. It's not required. We highly encourage it. Maybe a third of our lenders now are reporting to credit bureaus. What does it look like from an expense and revenue side? On the revenue side, you receive as the lender, you receive the 18% interest on loan. So on a $1,000 loan, it's $96. You also receive the $950 of the $20 origination fee. Most of that goes to pay for the loan and for the online access to the software. We do Rackspace, which is our online data storage platform, and our bill to them right now is about $3,000 a month just in online data storage. It's located and replicated in multiple storage warehouses around the country, so there's always redundancies and always backups, and it helps make the program legal. On the fees, the cost of joining the program, obviously if you're getting $950 of the $20 origination fee, you're paying $10.50 of that for the origination. The loan servicing fee is 45 basis points per month on outstanding loan volume. So if you think about it, if there's one loan over the course of a year, you would pay right at $35 per loan per $1,000 loan. We do an annual franchise fee of $250, and then you would have any state licensing fees on top of that. In Texas, the state licensing fee is a $600 application fee. That's a one fee, and then there's an annual renewal fee depending on your loan volume, anywhere from $600 to $1,200. You want to talk a little bit about the fee structure in Indiana?
Quite similar to what you just announced. We pay, the initial licensing was about $600, and we pay according to our volume as well on an annual basis. I will say that we also then too, since we're licensed, we an annual audit in which we have someone physically come to our site, and we provide a list of loans to them, and they select 3 or 4, and we print out all of the documents from the KIN system and put them in a file and take them, and they review them, and we discuss them. The great about the KIN system is that you always will have access to all of the paperwork and electronic signatures that the borrower has provided. So for those of you that are used to having the required lock cabinet that can't be burnt down if the building catches on fire, it's really nice to have storage that is virtual as opposed to on-site and where you're going to put all that.
That's really helpful. And so what are we asking? We are asking you, a potential local lender, to consider participating in the program. To follow up with, we'll send you some additional information. We're asking you to become a licensed lender regulated by your state if that's required in your state. We're asking for the $2,500 annual licensing fee. Right now, it is a 4-year license that we intend to keep renewing, but it doesn't lock you in forever, and there are termination agreements basically say that if at any point in time you want out of the program, you can get out of the program. Dedicate a staff person to recruiting and training the businesses and marketing to the employees. We do require proof of insurance, typically D&O insurance for your organization, and any professional liability insurance if it's required in your state. To work with us, if needed, Community Loan Center of America, to help raise money. We have been fairly successful in the past in partnering with local organizations, local lenders, to raise money for them through our national foundations and through collaboratives. Sherry, do you want to talk a little bit about the Pro Neighborhoods Award?
Sure. In 2015, which is one of the reasons we expanded and had the opportunity to reach a number of individuals in our community, is that we participated with 4 other CDFIs. Texas, there were 3 out of Texas and 2 of us in Indiana, and submitted a Pro Neighborhoods grant to J.P. Morgan Chase. That grant was for $5 million. And we did receive that grant, and ultimately each of us got just a little less than $1 million. And we all utilized those funds to either further lending that we were already doing, and in our case, we used it to launch our consumer employer-based loan product in a much more public way and being able to assist local businesses. So that's a great opportunity. I will say you as well that we had a lot of conversations with local banks, and we've received very favorable rates and secured other financing to be able to make sure we can sustain the volume as it continues to grow, as well as our local community foundations and the like shown great interest. One of the things that we can do as a CDFI is we can really apply for loan directly from the U.S. Treasury. So that's extremely very helpful.
Great. And, the J.P. Morgan Chase Award was great. It provided, grant funding, never has to be repaid. But we said in order to grow the program, you probably won't be able to rely on grant funding. But in working with banks and foundations, we've received PRIs and others, typically the 3 to 5 year term range with an interest rate usually around 2%, and the program works just fine with that when you're generating 18% interest. Frequently asked questions. We do a lot of conferences and other webinars around the country. Sometimes we get a lot of questions around financial counseling. Again, it's not required of the borrower to take financial counseling, but as a lender, you are required to be able to provide in some fashion no-cost financial counseling or coaching to borrowers who request it, and you need to be able to market that to them as well in your marketing. CDFI data, the KIN system, through the KIN system, you are able to pull the street address where people live, so you can geocode on your own where your borrowers live to make sure that 60% are in CDFI eligible investment areas for your CDFI test if that's important to you. Reporting to credit bureaus, it's not mandated at this time. We encourage it. We're trying to figure out a system and streamline a system by which we can all collaborate on it together. Right now, the 3 credit reporting agencies are requiring that each lender have their own contract or codes. We're not able to do it as a collaborative at this time, but we do encourage it. And again, about a third of our current lenders do report to credit bureaus. Break-even analysis and profitability. This is something we have pro formas that we've had created for the program. We're able and willing to work through those individually, given different sensitivities and parameters within your organization to help you determine if you'll be able to break even with this program. Targeting employers, we encourage groups to look at what their most stable employers are, and sometimes those are public employers, cities, counties, school districts. but sometimes it's private employers as well. We can help work through some very kind of easy econometric models, location quotients, some shift analysis to help you identify what those industry types look like. But more than likely, you already know that. You work in your communities, and you know who you would like to target. Raising loan capital, again, we suggest somewhere in the $250 million range to get started. We can help you raise that. We're willing to share any of the grant writing that we've done in the past with the language that's been successful. We're willing to share all of that information. Community capital, as well as the Rio Grande Valley Multi-Bank, we have loan capital that we've raised in the past that we're willing to lend out to startup and local LCs to help them expand. So there is ability for us to help get you started. And then adequate staffing, right now, like Sherry said, it's somewhere around 10 to 15 hours a month for staff. For organizations that are maybe grow a little bit faster or being a little bit more aggressive, it may be around a full-time equivalent to get the program off the ground. And customer service, you will get phone calls. Sherry's organization does a lot of their own customer service because they want to have that relationship with their borrower. Once someone becomes a borrower, all of the customer service is done in Brownsville, Texas, but they get a lot of questions up front for who are looking to borrow, and they would call your organization. Should I leave anything out on this particular slide?
So I will mention that there is a company by the name of Credit Builders Alliance that allows you to kind of group your credit reporting or borrowers together, and then they submit now, I think, to all three bureaus for a much more reduced fee. So that is maybe possible another opportunity for individuals that want to start out credit reporting. We found that that's extremely valuable to our borrowers and one of the key selling points when we go to an employer.
Have you done analysis to see how much a successful repayment of a CLC loan, what effect that has on someone's credit report?
Not.
Okay. Talking with Credit Builder Alliance and others, they were estimating it might be 20 to 30 points, depending on when one starts, where their credit is at the beginning of the loan versus the end of the loan. So, 20 to 30 points is very significant, depending on where they start. The difference between qualifying for a mortgage or not qualifying for a mortgage, getting a better rate on a car loan in the future.
I totally agree.
So these last slides are just some of the marketing materials that we can provide to the local lenders so that you don't have to create things on your own. And we're happy and willing to share all of that information once you are approved for the program. Here's my contact information. I look forward to working with many of you on the call and happy to answer any questions, and I'm sure Sherry is as well.
Ms. Kevin, again, we do have several questions here. First one is, what is the typical interest rate charged by the local investor in the loan fund? I think you had mentioned 2% from banks, but is there anything else you want to say on that?
Yeah, I know that we, obviously grant funds are preferred, and zero interest loans are the next best thing. The most I've heard of anyone paying to raise loan capital is 3.1%. Most banks and foundations with PRIs or mission-related investments are going to be in that 2 to 2.5 to 3 range, and that's fairly typical.
Okay, so you just mentioned that one. Is a loan loss reserve required for the program?
It's not required, but it is helpful if you have. Right now, with the interest coming in and the fees generated on the program, you should be able to pay loan losses from the program revenues. Obviously, if you're able to raise a loan loss reserve fund, that just helps you become sustainable faster. If your default rate is 3% or below, you should be generating enough interest on the program to help pay those losses. But again, where you can raise a loan loss reserve fund, that's even better, but not required.
Can I chime in and say that
Sure.
we at Brightpoint getting loan loss reserve grants from local lenders rather simple, and it's one way that they really enjoy, I guess, participating. So we do have loan loss reserve kind of policy that we've set for this particular product at 5%. Our default rate is not that high, but we do set it per loan. So we do actually calculate it and make sure that for every loan that we give out, we're setting aside a percentage.
Any point at the end of the year, the end of a fiscal year, do you reconcile that and then reconcile any loan loss that you've set aside as revenue at any point, or is it always earmarked as loan loss?
It's always, currently, we just earmark it as loan loss, but we have the option because it's a grant, and as long as there's no stipulations in that it's going to have to be reinvested as loan loss, we can then move it to revenue. But at this point, we've just circulate back into loan loss.
Gotcha.
Next is, what is the lowest and highest loss percentage within your network?
So now there's a very small lender in Laredo, Texas, that's 0 losses. And then the highest right now over the past 15 months, I do. Brazos Valley Council of Governments, they're at maybe 3.3% over the last 15 months. Historically, over the start of the program, they're at 3%. Highest we've ever seen was 12% in the Rio Grande Valley. That was in 2012 and 13. The reason is that they went, the Port of Brownsville has 5 major employers, and they had recruited them all through their work with the United Way and the Chamber. There was a round of union busting that went on, and all of a sudden everyone lost their job. So their default rate, I think at one point, was 12 to 13%. Since got it under control. If at any point the delinquencies or defaults from one particular employer start to tick up, you can set policy to where you have the option to no longer originate new loans to that employer. You can cease that relationship. When you recruit an employer, we provide you with an MOU that you and the employer sign, and it has very clear language that says, that at any point either party can separate from the MOU. And one of the reasons why a local lender would want to do that is if there's something going on at the company, start having high turnover rates, and therefore losses to get unmanageable. The leading cause of delinquency and default within the CLC program is employment separation. But we cannot mandate that payroll deduction be the only way to collect payments. But we can also debit from someone's banking account, and often, and the most common reason for someone to be delinquent is they cease payroll deduction because they were terminated from their company with insufficient funds in their bank account. Again, right now, overall, the entire network, that's 3%.
Some of the current CLCs raise the capital.
It's just like you would for any program. It's going to banks, it's going to foundations, it's helping. It's working with us to identify social investors. There's been a little bit of that, but really, it's banks, corporations, major foundations giving into the program. We have been introduced to a number of organizations we didn't know existed before. Faith-based foundations have been a major part of our fundraising and capital raising for the CLC program. We've those relationships before when we were just doing affordable housing, but they have a strong economic justice focus, a strong social justice focus, and they've really taken to the CLC program as a way to invest some of their resources. So, have you received money or heard of others getting money from any other kind of non-traditional sources?
No, for the most part, I think you would be dead on. I have had conversations with our local city government and CDBG dollars and seeing how we might be able to get an infusion of those.
Right. Okay, makes sense. The other kind of the untapped area is individual patient social investors. We have really made a big push to go out and recruit wealthy individuals to give into the program. We had a couple of cities give to the program. City of Waco invested about $250,000 into the program, really encouraged creation of a new fund within their local community foundation, and that generated about $500,000 for the lender in Waco.
Okay, the questions that I have, and I think we're at the 1 hour point. So I want to thank Matt Sherry for today's webinar. It was very informative. I also want to mention a couple of things. As I said at the beginning, I will be sending out to everybody who would register for the call a link to the recording and also a copy of the PowerPoint. And just a note that a couple of upcoming, well, we don't have dates for them yet, but Matt and I actually been talking about another session, looking at examples of where local groups identified economic opportunities that were not being met and formed social enterprises to take care of those and also generate income for the organization. And also, we're working with Windrock/Wall Center in Little Rock, workshop and tour for the upcoming annual convention in Denver in August, and we're planning to have a webinar probably in June that would complement that and get people's interest up on that. So those are two things we have forthcoming, so you'll see more information in our electronic newsletters about those. And with that, unless you guys have anything else to say, Matt and Sherry, got any last words?
Okay, thank you again for all of your help in helping pull this webinar together. We really appreciate it. Sherry, thank you so much for your valuable input as a local lender and as a community action agency on helping me get the word out.
Thank you. And I'd like to throw out there, I'm happy to speak to community agencies in regard to just how we integrated it into what we do, if that would be helpful.
Okay, Thank you, everybody, once again, and thanks for being on the call.